Good morning, everybody. Good to be back on here again. So conference ended yesterday, but I want to cover day 3. Yesterday was just too busy for me to do this, but I wanted to keep up with it. May have one more. We'll see how it goes, but try to get to it. And then we'll get into some details between now and the end of the year on things that I think will be more specific. But we talked about this a little bit yesterday, and they talked about the donor advised funds that came up again. Might even been a different instructor. So it really is something I want you guys to look into. The donor advised funds really do give you flexibility, especially now that the charitable contribution rules, or not rules, but the amounts has just gotten so high to be able to itemize. And also, I think I brought this up on the last one, but the qualified charitable distributions. So just to be clear, you're now having to do RMD. You're retired, they're making you take money out of your IRA, and then you're just turning around and giving that money back to a charity because you don't really need it. Or you just want to donate to a charity anyway. The problem is when you donate to that charity, because the standard deduction is so high, you're now paying taxes on that RMD and then giving it to a charity and not getting a deduction. So what you can do is go to your IRA, whoever's holding it, and say, hey, I want to do a qualified charitable distribution. They'll know what you're talking about, directly to this organization. And what happens is you now fulfill the requirements for the RMD, it goes straight to that charity, and you don't have to recognize the income. So they're a really good deal. I wanted to try to clarify that a little bit and make sure you guys understood it. Another thing that came up while we're still on the itemized deductions section is the concept of giving things to like Salvation Army, Goodwill, disabled veterans. But you're giving away clothing, property, non-cash items. And it seems like every year we have somebody, because maybe a relative passed away, maybe you're moving, whatever the situation is, where you just took truckloads of stuff. And so you've got $10,000, $15,000, and you want to deduct it, you think you're going to get to. The problem is the IRS has said for the whole year, the maximum that you can do that way is $5,000 unless you get an appraisal. So what that means is if you're giving away pictures, something high value, you're gonna have to get an appraisal for it. And if you're giving away a bunch of clothes, in practicality, you're just gonna be capped because you're not gonna get an appraisal on every single little donation you've done. It just wouldn't make sense. So in practical terms, 5,000 is your limit in that category. But if they are big items, antiques, something of value, you have to have an appraisal if you think you're going to get to deduct it on the tax return. I've seen times where people are giving away maybe collectibles and they thought they were going to get that deduction, but they didn't have an appraisal. So I don't want that to happen to you guys. Make sure if you're giving away big stuff, you get an appraisal, or at least give us a call. We can say, hey, yay or nay. So I want to cover that. But on that same concept, there's also, even if you're doing 500, 1,000, 1,500 of that, which is more normal for most people in a year, you gotta have records. Just that little blue slip they give you when you drop it off is not enough. So what I usually recommend is that you make a list, write it all down, get the pricing on there, and then use your smartphone, your camera, whatever you have, take some pictures. Some pictures that will help substantiate your deduction, because you don't want the IRS to toss it because you can't back it up. Because they have precedent, so you gotta have a way to just protect you. That's what we're trying to do, protect you. All right, moving on now, there's a lot of people, a lot of you actually that are watching this that have a VRBO or an Airbnb, or maybe you're just considering it. And those are still considered rentals, even though they're short-term rentals. And why does that matter? Well, it matters because one, rental income is not subject to self-employment tax, whereas rental with substantial services, that's the term they use, which basically means, are we doing housekeeping, maid service, things like that, while they're still there. Now you've crossed over and think motel. Now you're in a motel situation, and that is self-employment income and does get taxed at a higher rate. But as long as you're not providing substantial services, changing out linens. Now remember, if they stay there for a week, and then you change them after they leave, that's not substantial services. But if you're going in there and changing them while they're there, now we may have a problem. But the VRBO concept, as long as it's, like we always, those of us who've used it, those are rentals, and I want to make sure you understand that. Okay, so We also have, especially in this market, there's been a lot of people, a lot of our clients, a lot of you guys out there that are doing, I guess you call it house flipping. You're flipping homes, you're buying a house, you're fixing it up, then you're turning around and you're selling that property. And the question often is how do we tax that? Is that a self-employment concept so that we're paying self-employment tax, or is that investment? Problem is the court cases are all over the board, and pretty much what they all say is, I mean, not fully, but it kind of seems this way. Whatever's worse for you is how the tax court is going to decide. So we got to really be careful on this. Generally, I don't know, if you bought one, fixed it up, sold it, aren't doing any more, no more inventory, it's probably going to be an investment. But if your goal is to flip 2-3 houses a year or more, now it's probably self-employment, and we're going to want to talk more. Maybe we need to start thinking about becoming an S Corp or something else. But if you're only doing one, it's probably investment. If you're doing more than that, and maybe we'll do another video on that later, because there's a whole series of things to look at to decide, is this self-employment or is this investment? But just like I said, these videos I'm trying to cover a lot real fast. Doing one, maybe two, investment. Much more than that, we're probably crossing over into self-employment. And we're going to have to consider, I'm not getting that 15% capital gain rate. Now I'm getting ordinary income rates plus self-employment tax. And that's a huge difference on your tax. Okay, then we got into opportunity zones. And I talked a little bit about this last year. A lot of people don't even know what these are. They scare people. But from what I understand, there are some good ones. I'm not an investment advisor, so I really can't get into that very far. That's why you have an investment guy. Or if not, maybe we can help you find one. Opportunity zones, let's say you sold some stock. You had a big gain. You can take just the gain. You don't have to take all of it and reinvest it, but you can take the gain and put it into an opportunity zone. And I've heard, like, the guy that was presenting said there's some in Portland that are amazing locations managed by guys who have a proven track record of managing real estate. So might be worth looking into. I can't say I haven't looked at it. You can take that gain and not pay tax on it for up to 5 years. I think as of 2026 is when you'd have to recognize the gain. But you get to defer the gain, which might make sense because maybe you're in a high income year now, or even not, just deferring gain 5 years has a time value of money. You can defer it, but the bigger thing is if you stay in that investment. So you buy into this opportunity zone, usually they're real estate investments. If you hold it for 10 years, all of that gain is tax-free. So not only did we defer gain on this, but we now get to invest in what's hopefully a good investment, grow for 10 years. And whatever we take out of that is all tax-free because we helped be a part of funding this opportunity zone. So that could be a big, big thing. Like I said, I haven't looked into the specifics of the investments themselves. You'll have to do that, but it really might be a good opportunity for some of you that have recognized a lot of gain this last year. Okay, we talked a little bit about cash basis and inventory. Businesses under 25 million that are just being set up can maybe opt into cash and not tracking their inventory. For a lot of you, that may make a lot of sense. We'll want to talk about that during tax season, but I wanted you to make you aware of it, but I also wanted to make it clear so if some of you hear this isn't necessarily talking about you if you have an existing business. Not saying that we can't, but that is, in our opinion, a change in accounting method. And in order to do that, we'd have to fill out a 3115, do a lot of extra paperwork, and request that the IRS allow us to make that change. It's a pretty complicated process. So we're not talking about that. While that may be possible and may still be considered, but mostly this is going to be for new businesses that are just starting up. We may want to choose whether we track inventory on our financials, which will then maybe give you an advantage on the taxes, but we have to be very careful in how we do this because if we don't do it right, we won't fit the guidelines and they could disallow it. So if that's something that you think makes sense for your business, maybe we should talk about that one-on-one. All right, then we talked about lawsuits and legal fees and lawsuit income. And I think this one's a big deal because there's been a lot of times over the years where I have had a client come in who sued someone and got a couple $100,000, maybe even $500,000. But by the time they got through deducting the legal fees and paying the tax on the old lawsuit, they went through a lot of pain and really don't end up with that much money. So it's very important, one, that you understand that's possible. Two, it's very important if you're going through one of these that you work with your accountant at least on high level so that you know what's this going to do, and is there a way to maybe word it such that the legal fees might be deductible or the actual income might not be taxable. More so on that than the legal fees. But if it's for medical or certain things, it may not be taxable, but if the person you're suing words it in the wrong way, the IRS may say, yeah, well, maybe it was for medical, but the way the lawsuit's written, that's taxable income, and that could have a massive impact on the amount of money you get out of this. So if that's something that you're ever, hopefully not, but let's be real, it happens. If that's ever something you're in that situation, make sure you talk to your accountant during the process before you start signing documents, because maybe it can be done a little bit differently. Now, I'm not an attorney, I can't change all of that, but sometimes a few words can have hundreds and hundreds of thousands of dollars of impact. So just gonna hit it with there. Like I said, we can't cover all those details, but if that's you, let us in, let us help. Okay, and I think the last thing we'll talk about today is hobby loss rules. A lot of you have heard about, you gotta make a profit 3 out of 5 years, that kind of thing. But I believe it was the first video that we did a couple days ago, and we talked about the new 1099K rules. And what that means is if you're selling on Etsy or eBay or collecting payments through maybe Venmo or, there's so many options. But if you collect more than $600 starting next year, they're gonna be required to send you a 1099K. And what that means in simple words is the IRS is gonna know you've been selling stuff. So now that means you've got to file taxes on that. If you aren't running that business like a business, you may now have a hobby, and you don't want a hobby. And everybody says, go get a hobby, and that's great, but not if there's money involved. If it's a hobby, deemed a hobby by the IRS, that means the income is taxable, but the deductions are not deductible. So you might sell $5,000 worth of stuff. You might have $5,100 of expenses, so you lost money, but you're gonna pay taxes on the full $5,000 because it's a hobby. And that's the worst possible scenarios. There's a few things to think about here. One, do you act like a business? In other words, do you have a bank account? Do you have a website? Do you have business cards? Do you advertise? Do you keep your records? Do you have records? Let's be honest. Do you have the expertise? Do you know what you're doing? Not saying that oven by itself is a thing, but can you get the expertise from somewhere else? Some of those boxes you can check, but you don't have to necessarily have been in that business, but maybe your field that you were in, there's a way to say, yeah, I've got the expertise to do this. But there's expertise. Did you devote sufficient time? If you spent 10 hours in the last year doing your eBay business, that's not a business. That's most likely going to be deemed a hobby because you didn't put enough time into it. You weren't really trying to build a business. And there are a few other things. So if that's something you have a concern about, maybe we should talk about that while we're doing the tax return. I'll give you a few pointers, give you the full list of things that the IRS is looking at. None of them by themselves are the answer, but you have to look at the whole picture and say, yeah, that's me, or no, that's not. And if I am a hobby, maybe I can start checking some of these other boxes to move it from a hobby to a business so that you don't just get hammered on the tax return. So that's it. I wanted to give you guys another one. We'll do one more. That one's gonna be probably on the IRS portal, some crypto stuff, maybe some equipment, buying equipment for your businesses, things like that, and that'll wrap up this series. Hope this has been helpful. Never tried this before. Definitely a different challenge trying to do this out of your element, but I hope you guys liked it, and if so, maybe we can do more of this kind of thing. See you guys soon. Tax season's right around the corner, and let's get to planning.